important concepts out of chapter 1 were number 1, accounting equation, and accounting equation being assets equal liabilities plus owner's equity. And then it introduced to you what assets are all about. Assets can be classified into 2 categories: current assets and long-term assets. Current assets are the assets that will be used within the next 12 months, within 1 year, typically. Long-term assets are assets that will stay, that will benefit the company. Those are resources that will be used beyond 1 year. So current assets, the definition of current, the word current, C-U-R-R-E-N-T, would be any asset that will be used or expired within 12 months or 1 accounting cycle, whichever is longer. And usually accounting cycle is 12 months, but sometimes it could go up to 15 months. Okay, an accounting cycle is from the time that you have cash. Now, imagine you want to start your business, right? And what is the first thing you need to have when you want to start your business? Let's say you want to sell coffee on campus. You want to sell hot dogs. What is the first thing you need to do? Who wants to tell me that? What do you need to do to start your business?
Some type of
we need
license.
capital.
Arya, what was it?
I said some type of license.
Okay, but is that the first thing you need to do, is to go get a license?
We need some capital.
You need to have what, Sadvik?
Capital, money.
Yeah, money. So license is absolutely important, and that's one of the first things you do. But in order to get a license, you have to pay for it, right? Therefore, you need to have money. You need to have, we call it capital. You need to have cash. So accounting cycle starts with cash. So you have cash. You go get your license, as Arya said. And then remember, you want to sell coffee. So what's the next thing you need to do? Who wants to tell me, what do we do next? So you want to sell coffee, you have cash, and you went and got your business license. Now what do?
Purchase goods.
Purchase coffee, very good. You have to purchase coffee in order to sell it. Purchasing coffee, we call that inventory, because you're selling, you're buying coffee for the purpose of selling it, right? So therefore, a business cycle, an accounting cycle, starts with having cash, buying inventory. In our example, it was coffee. And then, so now you have inventory, and you're sitting at a place on campus or in some street corner, and now you're selling inventory. When you sell your inventory, now if you are a big business, you could sell your inventory on account, meaning that, for example, Kim is going to come to Sadvik and says, hey, Sadvik, I want to buy 2 cups of coffee, but I don't have money right now to pay you. I will pay you next month. So Sadvik says, oh, you're good. You have account with us. Therefore, we trust you. Here's your 2 cups of coffee. Just we will send you a bill. That's called accounts receivable. What Sadwick did, he sold inventory, what we call on account. On account meaning that sold it but didn't get cash for it right away. Okay, so we're looking at accounting cycle. First, you have to have cash, then you go get inventory. And we said the definition of inventory is what you buy for the purpose of selling it. In our example, it was coffee. Now a customer comes, buys our coffee on credit, on account, right? On credit and on account, both term means the same thing. And then we're going to send Kim, our customer, a bill to pay her account next month, right? So therefore, we go from cash to inventory to accounts receivable. And next month, Kim is going to send Arya, who is the owner of coffee shop, cash, a check, and a check is considered to be cash, or maybe paid via Venmo, whatever form of payment it is. So what happened, one accounting cycle was cash changing into inventory, changing to accounts receivable, changing back to cash. So I was looking at current assets. I said current assets are any type of assets that have a life of 1 year or one accounting cycle. And I said accounting cycle could go up to 15 months. Okay. But typically, well, let's just stick with 1 year because it's easier to remember that. So going back to the original introduction of chapter 1, I said the most important topic out of chapter 1 is accounting equation. Accounting equation equals assets. And accounting equation is assets equal liabilities plus owner's equity. And I mentioned, now I'm gonna just share my screen. And I am going to use the whiteboard. Okay, let's see. I'm going to share. Okay, so I said assets. Actually, I don't like the whiteboard. The way it takes a long time to write it. I think I'm going to just forget about the whiteboard. Let's use I want to go back to modules. And on modules, if you go to chapter 1 through 9, in chapter 1, I'm going to click on it. It downloads it. And there you go. Accounting equation, assets equal liabilities plus owner's equity. Okay, we mentioned assets consist of 2 categories. Short-term assets, which we call current assets, and long-term assets. Long-term assets are assets that have life of more than 1 year or one accounting cycle. Can anyone think of what would be a long-term asset? Something that the business, the company owns, that it's going to provide services to the company. It's going to be a resource to the company for more than a year. Anyone can think of a long-term asset?
Land.
I'm sorry, what?
Land.
Land, excellent, because see, land is not something it's not like cash that you're going to use it up. Land, it's going to stay in your business, and you will put a building on it, and you will do business for a long time. So land is a long-term asset. Building is a long-term asset. Equipment, you buy a computer. Equipment is a long-term asset. So we call those land, building, and equipment. Those are all long-term assets. So, well, chapter 1, the important part of chapter 1 was assets equal liabilities plus equity. I called it owner's equity because we said, let's assume I'm the only owner. But if there were two owners, which we call that partnership, then it would be partner's equity. If the equity was selling stocks, if we were a corporation, then we will have many owners, and we call those stockholders. So we will be calling equity stockholders equity. Okay, so that's why you will see equity here. I am going to make this a little bit larger so you can see it. Awesome. Okay, so that's we looked at assets. Now let's take a look at liabilities. Liabilities are also divided into two categories: short-term liabilities, current liabilities, and long-term liabilities. When you think of the word liability, there's one word that should come to your mind. Remember how Kim went and bought coffee on account from Aria? So what Aria had was accounts receivable. Aria's business now owns an accounts receivable, and we said accounts receivable is a current asset. See, it's receivable means it's money that will be received in future. Okay, so and then one word that would describe assets would be own, O-W-N. The business owns a land, the business owns a building, the business owns cash, the business owns accounts receivable. The business owns inventory. So it's always own, O-W-N. Now going to liability, what do you think would be one word that would describe the liability? Anyone? It starts with letter O. Anyone? Going once, twice. So liability, one word that would describe liability is O, O-W-E, what the business owes to others. Okay, so liability, the definition of liability is what a business, Aria's coffee shop, owes to others. Maybe Aria bought his coffee, the coffee that he's going to sell, he bought it on account. He bought it without paying for it, and went to Starbucks and said, hey, I have an account with you. I'm going to buy coffee and I'll pay you next month. Okay, so we call that accounts payable. Notice accounts receivable was when we sold on account to a customer. So the keywords are sold to a customer. So there's customer involved, on account. That's accounts receivable. Accounts payable, which is the other side of accounting equation, is when we owe a company because we purchased on account. See, accounts receivable is sold, accounts payable is bought. Aria wanted to start his business. He went to Starbucks and bought coffee on account. All right, so we call that accounts payable. So we were talking about liabilities. I said liabilities can also be divided into two categories: short-term liabilities that the business must make a payment within 12 months, and long-term liabilities that the business is going to make payments for the next 30 years. For example, think about when you buy a house, right? When you buy a house, you usually put a down payment, right? And then you borrow the rest of it from a bank. And every month you make a payment to the bank, right? We call that mortgage payable. So mortgage payable is a long-term liability, right? So accounting equation, the most important topic out of chapter 1 is assets. We went over assets equal liabilities. And I said liabilities are what the business owes. It can be divided into two forms: current liabilities, also called short-term liabilities, and long-term liabilities. Current liabilities, you must make a payment within the next 12 months, or as I mentioned, one accounting cycle. But as I mentioned, let's go with 12 months because it's easier for us to remember. And then long-term liabilities are liabilities that we're going to make payments for many, many years to come. Just like when you buy a car, for example, you just sign a note for 3 years. Every month for the next 3 years, you make a payment to the car dealer or to the bank that you financed your car from. So that is long-term. Okay, so assets equal liabilities plus equity. And I said equity could be owner's equity if the business is formed as a proprietor, as a single owner. That was the case when Arya owned his own business. There was no partner, there was no stockholder. He gets all the profit and he gets all the loss. He needs to come in with cash. So it's a lot of responsibility, but a lot of control at the same time, right? So that would be one form of business, to start as a proprietor. We call that proprietorship, single ownership. In that case, we call equity owner's equity. All right. Or another form of business is partnership, when we have 2 or more owners. Each one of them come in with a certain amount of cash. Each one of them is liable for company's debt, company's liabilities. And then they also share profit together, right? So that is, we call that partner's equity. That's another form of business. Or stockholders' equity, when we have many, many owners, which we call stockholders. Okay, if you place an order at Charles Schwab, let's say, to buy 2 shares of Facebook, you're now, as soon as you own shares of Facebook, you're the owner of Facebook. We call you stockholders. Therefore, this would be stockholders' equity. Okay, so that was the most important topic out of chapter 1. Of course, there were topics about important organizations in accounting and talking about the organizations that if they investigate a company, the company will be in trouble. Can anyone think of one government agency, organization, that if they come and say, investigate, they go over financial statements of Starbucks, we've been using Starbucks, that company's stock all of a sudden is going to go down because everyone gets nervous. Oh my God, why is this organization reviewing financial statements of Starbucks? Can you think of the name of that organization? it talks about that in this chapter 1. Kim, any idea? SEC,
FASB. Okay.
SEC.
Yeah.
SEC,
Okay.
thank you, Cedric. You know, I love it when you participate. So I thank you so much. And it's okay if your answer is wrong, because this is just the introduction for you. But the participation makes this Zoom office hours a lot more exciting as opposed to me talking all the time. So thank you for participating. I'm most grateful to you. So SEC, Securities and Exchange Commission, which is a federal government agency. And if that organization has great effect on what we do as accountants, what every corporation's accounting department does, what every corporation's management does. So SEC says, you want to be safe, follow rules and regulations that are set for you, which we call, do you remember what rules and regulations accountants must use to report their balance sheet, to report their income statement, to report their statement of cash flows, to report the statement of stockholders' equity? Do you remember the name of those rules and regulations? Those are really important. It's like when you get into your car and you go from one place to another, you follow rules and regulations that are included in the DMV book, right? So as a driver, you have to follow those regulations. Accountants must follow certain regulations when they prepare their financial statements. Can anyone think of the name of those regulations? It consists of 4 letters, and each letter is the abbreviation for something.
Generally accepted accounting principles.
Great job, May. Thank you. GAAP,
Thank you.
generally accepted accounting principles. So remember GAAP, not GAAP, the store merchandise, but if that helps you remember it that way. But it's generally accepted accounting principles. All accountants who work for a corporation must follow GAAP rules. Those are like DMV books for a driver. Accountant is the driver, and the regulations in the DMV book, we call them GAAP, generally accepted accounting principles. So, so that is, chapter 1 talks about GAAP. All right, so those are the most important concepts out of chapter 1. And then, so read my little lecture. It's a summary lecture on chapter 1. See, here's we talk about GAAP, talk about proprietorship, partnership, LLC, limited liability company, which is usually a form of business organization that a single owner selects to protect themselves. So that is, we talk about business organization, and then we talk about assets, liabilities, owner's equity. All right, so that was the most important thing out of chapter 1. I have some exercises. You can do the exercises, and then at the end I have a quiz. And this is not a quiz I have designed. This is a quiz that your publisher has designed, and it is right over here. And you can take the quiz and then take a look at the answer key to see if you understood the chapter. Okay. By the way, your midterms, your final exam will be very much like these questions. It will be very, in fact, I wouldn't be surprised if you see that exact same question on a first midterm. So that's why I say it's really helpful to do this. So that was chapter 1. I'm going to close this and then go to chapter 2. So chapter 2 is all about debits and credits. And let's go to chapter 2. So this was chapter 1. I'm going to go back and let's see if we go next. That should take me to chapter 2. There you go. So chapter 2 is about debits and credits, right? Now we know we have assets, liabilities, and let's go with the proprietorship right now, owner's equity, because we can all relate to owner's equity. We can all relate to starting my own company by selling coffee, or starting my company by doing tutoring. You know, when you don't have to sell a merchandise to be a company. You can sell a service. I can do tutoring for you. I can be a doctor. That's a service. That's a business. I can be an accountant. That's a service. I can come clean your house. That's a janitorial service. I can be a dentist. So those are all businesses, and they're typically just a proprietorship. So looking at chapter 2, we're going to take a look at how these accounts, when they increase or decrease. When I'm talking about accounts, I'm talking about accounts under assets, accounts under liabilities, accounts under owner's equity, how they behave with increase and decrease of those accounts. I mentioned, for example, as assets, I mentioned cash, I mentioned accounts receivable, I mentioned inventory, I mentioned land, building, equipment. Those accounts under the caption, the classification assets, would behave in certain manner. Under liabilities, I mentioned accounts payable, I mentioned notes payable. Remember, I said you buy a car and you sign a note, a 3-year note to finance your car. That's notes payable. Or you buy a house and you sign a note, which we call mortgage payable, right? So those are all liabilities. How do they behave? Then we have owner's equity. Under owner's equity, we have owner's investment itself. Remember how Arya wanted to start the business, and he started the business by taking cash out of his own personal savings and started the business, right? So we call that owner's capital. That's owner's investment in the business, right? So that is under owner's equity. Under the caption, under the classification owner's equity, we have owner's capital. What else do we have? Now, if the owner withdraws money from the business, so Arya, the owner, proprietor, single owner, he starts his business by taking $500 of his own personal money and puts it in a bank under the name of the business, Arya's Coffee Society, let's call it. So Arya's Coffee Society is a business, right? And now, if Arya opens the cash register and takes $20 out of the cash register of the business and takes May to lunch, just because they're friends, they're good friends, they're going to go to lunch and talk about what's going on with life. Now, their conversation has nothing to do with business. Therefore, the $20, we call that withdrawal, owner's withdrawal. So anytime owner takes money out of the business, we call it owner's withdrawal. Now, the owner can take money, the $20 out of business, and goes to Office Max and buy supplies for the business. That's not owner's withdrawal, because Arya took the money and bought stuff for the business. Therefore, we call that office supplies. Office supplies is what Arya's business now owns, OWNS, right? That's an asset, not a withdrawal. So we were talking about what accounts will be under the classification owner's equity. We said capital, which is the money that he took out of his own savings account, put it under the name of the business. Then I said owner's withdrawal, which is when the owner took money out, not for the purpose of spending it on a business, but spending it on himself by taking his friend out to dinner. All right. Sometimes most owners of businesses take money out to pay for their own expenses, to pay for their own rent of the place they live. So that is owner's withdrawal. Then at the end of the year, let's say that Arya paid $300 to buy inventory, and then he had other expenses. Altogether, he had $400 of expenses, but he actually sold the coffee for $1,000. So his revenue is $1,000. His expenses are $400. Guess what his profit is? Anyone?
600.
600, very good. So the 600 will go under the caption owner's equity. Okay, so under owner's equity, we have owner's capital, we have owner's withdrawal, and we have either net income or loss. In this example, Arya made $600, which is net income, right? But if he had spent, say, $500, but he would have only made $300, then he would have had a loss. Okay, we don't like losses, so let's just stay with profit, right? Stay positive. All right, but we could have a business could have a loss. So that is those are the accounts under owner's equity. Now we're going to take a look at how they behave, and that's the subject of chapter 2. And I'm going to download chapter 2. There we go. So chapter 2 talks about, why did it go that fast? It talks about, see, debits, credits, what are the normal balances, and double entry. So let's go with debits and credits. That's the heart and soul of accounting, debits and credits. Now, the best way to learn debits and credits would be by using, I'm going to just open a blank. I don't like using whiteboard. I just don't have, I don't like it when it's all messy. So I want to open a blank. There you have it. Okay, so that's how we're going to, we say assets increase are shown on the left side of an account. So you might say, well, what is an account? Account is a tool that accountants use. Now, if I'm a carpenter, my tool is what? Hammer. If I am a cook, my tool would be maybe knives and spatula and all that. For accountants, their tool is what we call an account. Now, I'm going to now use the whiteboard. because drawing a T count is difficult, so I will use the whiteboard here. Let's see, I think I need to let's see if I can find the whiteboard. If not, I'll just open one. Yeah, okay, so let's just stop sharing. And now I can see. Where's my whiteboard? There it is. Okay, so I'm gonna just get rid of that. Let's clear that and erase. Okay, and then now I'm going to all right, so we're looking at, no, I don't want that. I want to draw, there you go. Let's see if that would work. Okay, there you go. Now, right there. All right, obviously my whiteboard is not cooperating with me. Oh, there. All right, so a T account is literally shaped like a T. I was hoping I can. Let's see if I can start again and share. Oh, there you go. Okay, so this is a T account. I said this is what accountants use as their tool to show increases and decreases of assets, liabilities, and owner's equity. So for assets, I'm going to put assets, and remember, we don't have an account by the name of assets, but we do have accounts by the name of cash, inventory, accounts receivable, office supplies, land, building, equipment. So those are all assets. Now, the rules of debits and credits, I mentioned that every increase is shown on the left side. So the left side, this side, we call that the debit side. In accounting, the left side of an account is called a debit side. And guess what the right side is called, everyone? What do we call that? Remember we said in chapter 2, the main focus is on debits and
Credit.
credits. Thank you, May. So the right side is called credit side. Okay, so now we said any increase in asset, we're gonna put it on the debit side. Any decrease, we record it on the credit side. For example, if you remember, Arya started his business by taking $500 out of his own savings account and start the business. So I'm gonna open an account called cash. Now, I have not used whiteboard. This is something new that now Zoom offers. So how do you go to no? I want to just go down to another page. Let's see, I wonder if that will go. There you go. Okay. So cash, remember, is an asset, right? So let's call it cash. Cash is an asset, so we're going to say Arya took $500, put it under the name of the business. We call that cash. And we said any increase, remember the previous screen was, we said any increase should be recorded on the debits on the left side. And we said the left side is called the debit side. Now it's 6 o'clock. It's my goodness, it became 6 o'clock very quickly. Is that almost 6 o'clock? Yeah, I have 3 minutes. So we put debits or increases on this side by putting the $500 here. And then on the other side of accounting equation, which we learned, we're going to open an account, call it owners capital. And now any increase in capital should be recorded on the credit side. Then we will put the $500 here. Okay, so I want you to learn about the debits and credits. We only have a couple of minutes left. In general, now I don't know how to go back to the previous page. I'm gonna work on learning how to work with the whiteboard. I wanted to show you that assets, any increase would be on the debit side, decrease will be on the credit side. Liabilities, such as accounts payable, such as notes payable, mortgage payable, increase will be shown on the credit side, decrease on the debit side. All the capital, including owner's capital, owner's capital, the increase is shown on the credit side, decrease on the debit side. Now, remember owner's capital had one account by the name of drawings, owner's drawing. Owner's drawing acts like asset, even though it's not asset. Owner's drawing increase is shown on the left side, which we decided to call it the debit side, decrease on the credit side, which is the left side. Wherever the plus sign is, we call that normal balance, normal balance. So where the plus sign is, that's normal balance. The normal balance of assets, all debit. The normal balance of owner's drawing, all debit. The normal balance of owner's equity, credit. Normal balance of liabilities, credit. Right-hand side of an account. So that's really the focus of chapter 2. We had enough time to go over debits and credits. That was good. It's 6 o'clock. I'm going to start now. My next office hours are my managerial accounting class with accounting 1C. But do you have any last minute question? So I want you for 1 second, unmute yourself and tell me, did you find this to be helpful? I'm going to stop sharing. What did you think of today's going over chapters 1 and 2? Was that helpful?
Yeah,
Yeah,
can you
I would
help
say,
me revise? Okay, go ahead, go ahead.
thank you. Well, based on like the assignments I did, I just was a little confused on certain things. So it's always nice to have like a teacher kind of go over it to make more sense. So I definitely got like more clarity on stuff.
Wonderful. Thank you. Thank you for the feedback. Awesome, guys. Well, thank you. I wish we could stay and talk more, but I'm going to go ahead and start the managerial. Have a wonderful, I'm going to pause the recording.